Perfect. So again, good morning, guys, and this is the MotiveWave Wednesday webinar for December 17th. This is Fed Wednesday, and this is a very critical Fed meeting. Obviously, it's the last one of the year, and there's been a lot of talk about what exactly the Fed's going to say. And I'm a technical trader, as probably most of us are, but it is important to understand what the fundamental people are saying. Okay, because there's a time when you have to kind of watch the fundamentals and know what people are talking about. Rarely will I ever trade based on what the fundamental guys are talking about or what they're recommending, but I always want to know what they're expecting to happen. Okay, you want to know what the story is. You want to know what the narrative is. You want to know what the theme is. Okay, because if you know what you're expecting the fundamental world, if you know what they're expecting to see, fine. You just put that in kind of one pocket off to the side, and then you go over to the charts and you say, okay, I know what the fundamental world is expecting. Now let's put on our technical hats and say, okay, here's what's actually happening. And the difference between those two, a lot of times, is a trading opportunity. Okay, when the markets are fundamental, people are expecting one thing, but they're not spending the time on the charts and really understanding, what the structure is and what the psychology of the market under discussion is. Then, that's why fundamental guys get whipsawed a lot, because a good trade is either the fundamental people are expecting a market move and the wave structure is in a position to allow for that continued fundamental story to play out. Or if a fundamental story is too played out and too many people believe this is the case, and the fundamentals and the technicals are saying, okay, well, that story is played out, the trade is what they call crowded, and it's time to look on the other side, then that's really where some of the best trades happen. Okay, because a fundamental story can be very well entrenched and very well making the rounds, but if there's no one left to really put money behind that trade, then it doesn't matter how strong the fundamentals are. The psychology of the market is going to make it such that it's time for a turn. Okay, so with that being said, we'll apply that kind of psychology to each of the major markets and show what people are expecting coming in based on fundamentals and what probably, and I say probably, I don't know for sure. My crystal ball is currently in the shop for repairs, but we'll see what probably is going to happen. As my cell phone rings during MotiveWave Wednesday webinar day. Who calls me then? Okay, so crude has been the big decliner, and let's kind of go to the longer term and determine where we think crude will go. And let me just get my questions up. Okay, Alex definitely will cover dollar yen. Yeah. Okay, so here's crude on the longer term, and those of you who've been following me along, I've been covering this chart quite extensively, and actually let's do it on this guy right here. Okay, perfect. And let me just hide that below. Okay, perfect. So, crude. The decline from the highs in 2008 was just a massive slide, right? From 192 all the way down to 64. So it's a $130 move, right? And we're going to go ahead and just consider that an A wave, okay? Because we then fell into a pretty extended triangle in B, and triangle just characterized by lower highs and higher lows. It has 5 waves, A, B, C, D, and E. So very, very good chance that this is a triangle, and triangles will happen in B waves, okay? They can also happen in a 4th wave of a 5-wave decline. 1, 2, 3, 4, 5. Triangles can happen in the 4th wave, but I think it's pretty safe to say this is not a 4th wave because I only see 1, I don't see 2, 3, that doesn't really look like a 5-wave move. It looks more like this, which is an A, B, C. Triangles can often happen in B waves. And we'll just decompose as a triangle. Okay, oops. I gotta decompose. get a little bit more room for that to, hold on, degree. Let me just do this. Properties, Elliott. I'll do that later. But basically, it's hidden because I have the small degree hidden, but it's inside this B wave. So that is likely an ABC decline. Now, one of the ways to do that is, and to figure out how far this next C wave decline will go, we'll look at distance traveled in A. This was about a $130 decline. All right, so a lot of times the A wave will go at least as long as the C wave. Okay, and what I mean by that is, let me say that again, the C wave will go at least as long as the A wave. So if this was $130, you'd expect about a $130 decline. The problem is the C wave here starts at 105, so we can't go negative. So a really important chart setting here is to go to semi-log, and we discussed this last week. When you go to semi-log, that is going to change your axis over here to put it in terms of percent change. That's going to change where your fib ratios come in. So now, if you look at a percent decline from 192 to 64, a similar percent decline from 102 will give you a quality down at $34 a barrel. Okay, do we think it's possible we can get there? Yes, I do think it's possible. Is it probable? Too early to tell. I don't know. We're taking it one step at a time. What is probable, and I think what's very solid support, is the 0.618 relationship. So basically what this 0.618 is saying on the semi-log scale is the percent decline from here. You take 0.618 of it, which is your fib ratio. That's going to give you a target of 52.55. Okay, and a lot of people keep saying, oh, Russia's, Russia, Norway, all these oil exporting countries, they're saying OPEC can take, Saudi Arabia can take $50 and $18 barrel oil. This is a time you say, okay, I think we've got to start to look on the other side of this trade. The fundamentals are very well entrenched in a lower crude oil price, but we have a serious fib support level here at about 52.5. Okay, along with that is we have the C and B relationship. So we've just done A wave compared to C wave to get these two fib, and then we need to do a B wave compared to C wave. And a very typical C versus B is a 1272, which basically means you take this distance and multiply by 127%, and that's at 56. Kind of a lower extreme is 161%, which is another fib, at 48. So now we have a 3-level fib support zone here, 48 to 56. Okay. Now, those of you who are a little schooled in Elliott will know, because we have this labeled as a 5-wave move in A, this must be a 5-wave move in C. So as we stretch this weekly chart out a little bit, we say to ourselves, okay, can we count a 5-wave move? And so far the answer is no. We have a very shallow 2, nothing that resembles a wave 4 yet. We need another correction. So the way I'm combining fib price and Elliott is we are looking for a wave 3 low here. And there's I think a very good chance that we are going to respect this zone from 48 to 52. The top level, the 1272, 56, 64 did not hold. We're down here 52, 55, which is a major support. So I think that fib support is going to act as the wave 3 low. We'll get a little bit of a wave 4, and then one more push down in wave 5. Okay, so I'm respectful of the trend going into the Fed, but we have to see how the Fed plays it and what the terminology they use in there. But more importantly, the trade, I think, is becoming crowded to the downside, and we should see a bounce from around the 50 level back up to around 60 and just wave 4. So that's what we're looking at for crude going into the Fed. All right, from the weekly, let's go out to the daily and kind of clean things up here a little bit. 1, 2, probably looking at something like this, 3, 4, and a bounce up. Okay, so there's not really a lot that I can see yet in terms of wanting to call the end of this. Let me just go one more small degree. Intermediate, Yeah, we're going to have to do a little bit more work on this guy. I won't get into too much detail there on the crude oil market, but I do think there's lower prices down to about 52. Okay, so I'm just going to leave that one there. I know that chart looks a little confusing, but I'm just going to leave you with that 52 level. All right, something within a market analysis that's been pretty important is the correlation between crude and the S&P. All right, so let me just set that chart up here in a market analysis. This is going to take a second for the price data to come in. New chart window. Let's do this at ES. And this is how you do an overlay on MotiveWave. Okay, so we'll just do like a 2 hour. So here's the S&P futures. And then I'm going to right click, add study, instrument overlay, and I'm going to add crude oil on top of that. I'll use the 24-hour product QM. And it's going to be in blue, and hit create. And just give it a second for that data to come in, and then you're going to see an overlay of the S&P futures and crude oil. And what's interesting is you will notice that they were pretty well correlated here in March, in June. Then what happened is crude oil started to break away, and this is when the correlation broke apart. S&Ps continued higher, crude oil just went sideways, then they both dropped together into that October low, and then here's where the divorce happened. So the S&P rallied sharply where crude oil began to drop away quite sharply. So what I want to do is, okay, I know from pretty much until the top in the S&P, which is December, the correlation is broken apart. But as we go down to a smaller time frame, let's go to a 1 hour, you're actually going to see that the correlation between the two is quite strong. So just since that December top, as I line these up, you'll see that the correlation has realigned and they are in fact trading together right now. So as we bring crude on top of this, and you're doing this overlay, it takes a little bit of, I don't want to say, you just got to kind of train your eye to look to see where the correlations are, and you can overlay them and say, okay, from that December 5th top, we started to see a very clean correlation of crude moving to the downside. Okay, now here's the first thing that sticks out to me, a little bit of what we call intermarket divergence. Crude is off the lows here this morning, where the S&P following yesterday's close was very weak. Okay, so crude has been crude has been declining ever since way back, where the S&P just started on December 5th. So it's safe to say that the crude oil decline has caused the S&P drop. Now, crude oil has not moved to a new low where the S&P has. And if you think about it, S&P is down here because of crude. But now crude is not towards the lows, so that's a short-term intermarket divergence. When you have that kind of intermarket divergence, you then go over to the wave counts in the S&P, the market that you're looking at, and you'll say, okay, I'm getting a signal from crude that the S&P has reached a low. You then go over to your wave count in the market that you're studying, which is in this case is the S&P, and you say, okay, is the intermarket analysis divergence that we're seeing from crude in the S&P being confirmed by the wave count in the S&P? And that's the two-step process you take to put together a trade. First is intermarket analysis, knowing the correlations and how they impact each other, and then going over and squaring it with the wave count. So here's the S&P on a 3 hour. Okay, and before we jump into the S&P, let me just kind of underline this point that I made earlier. If you're newer to Elliott, the simplest way to get started with Elliott is to basically look for these and to look for these. Okay, what I mean by that is if you see a majority of the trends or the efforts or the price trends in the market as 5-wave declines heading to the downside, okay, you have a 5-wave move heading down, You have a 5-wave move heading down. And a majority of the up action being 3-wave corrections. And basically they're just going to fit together like this. Okay, after a 5-wave decline, you see a 3-wave rally. After another 5-wave decline, you see a 3-wave rally. When you just see that, okay, that tells you that the trend in this market is down. And you don't need to know anything else about Elliott except that you are aligning yourself with the trend of the market. And if you can align yourself with the trend of the market, then you are putting probabilities on your side. So one quick way to go back to the S&P is you say, all right, this market is in a pretty steep downtrend here. If we kind of zoom in on this 3-hour price action, can we see a 5-wave decline? And I want to go over the hourly chart to really zoom in on price action. And right now, what I think is from the highs, that's a first 3-wave move, ABC. Okay. We have another one, I think. We have another move down, A, another B, and another C. So I think this whole thing looks very corrective. If you compare that to the price action that we've seen before, the rally higher in since October 15th lows, I mean, you can count 5-wave moves all over the place. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Even in here, 1, 2, 3, 4, 5. I mean, there's 5s everywhere. And I think over here is 3s. So I think the direction of this trend is higher because we have 5s up until that December 4th high, and we have a bunch of 3s post December 5th down into the low. All right. And if you couple that with the crude oil divergence, and we could just throw it right over this chart if you want, add study, and we just go at QM, you're going to see that divergence again. Crude kind of up and off the highs here, up and off the lows, where S&P traded right to the low at the close. And I think part of the reason that we're seeing a bounce here this morning, the S&Ps are up 0.25%, Nas is up 0.2, Russell's up 0.75%, and it was actually up higher. It looks like it's giving back a little of the gains, but I think part of that reason is because of that intermarket divergence. Okay, so let's now go to work on the structure of this decline in the S&P. Go back to a 3-hour and let's simplify things a little bit. All right, let me just hide this and below, just get simple. Okay, so the first thing we're doing is off the lows here in the S&P. We're down in wave 2, and the first level is the 38%, which we closed right at, 1976. Okay, that's going to be the first support level. Below that is the 50% in 1945. Okay, so this is your fib retracements, it's your higher zone. Next thing you want to do is get inside of your two corrective waves, W and Y. Okay, so there's W and Y. The way you study those is you go ratio analysis, right click, Y versus W right there. Okay, equality, should have kind of held, but it didn't because the higher degree wave count told us we haven't got to the 38% yet. And then we're down to the 50%. So these are the typical wave 2 retracements because they are in green and white. Blue means it's a very early one. Okay, this is a higher degree wave count than the red. This is covering a larger price scan, so larger price span. So those carry more weight. So the 100% should have held, it didn't because we're not down to the ideal wave 2 levels. So we're looking for lower levels. Two good levels are the 1618 and the 200%, and they are surrounded by the 38 and the 50%. Okay, so I really think there's going to be support here in the S&P between 1980 and 1945. That should be a wave 2, and if that's the case, I think the pressure should come off crude just a bit. All right, now I want to switch over to gold, and gold is another market that we're looking at that has a very similar kind of dichotomy between 5 waves in one direction and 3 waves in the other direction. So let's go to gold. Now, if you look at gold off the lows, okay, the gold low was November 6th. You can argue for 5-wave movement in one. You could argue for a 3-wave correction here, A, B, down, and C. Another 5-wave move up. And let me just bring in one small degree, Elliott. Minor, minute. Okay, ABC down in 2. You could argue for another little 5-wave move up in 1, and then a correction down in 2. Okay. This is a really, really interesting point right here. Okay, the gold market, the only way I can really count this is for a 1-2, 1-2, 1-2. Now let me just put that in the context of what that means. Let me just make you a quick drawing. Degree increase, decrease. Basically what that means is, okay, you're in the strongest, you should be in the absolute strongest breakout point if this wave count is correct. A third wave is generally the strongest wave. So there's the third wave at the green degree. Inside of the green 3, we'll have 5 smaller waves. Those are your red waves. Zooming in even further, the wave 3 of 3 is your strongest wave. Red 3 should have 5 smaller waves as we keep getting to smaller time frames, and those are your 5 waves. There's black 3. So basically what this wave count is saying is we are right here in the biggest breakout wave. The wave 3 of 3 of 3. These only happen a couple times a year. Okay, those are where the biggest price gains are made, absolute huge breakout. Okay, so when you kind of find yourself in a wave count that puts you into a 1-2, 1-2, 1-2, the market has to go like straight up at least $100, $150 in like the next 4 or 5 days for this wave count to be correct. Okay, I think the probabilities just all the time of having a wave count that says 1-2, 1-2, 1-2, and no, I'm not doing a rap song like microphone check 1-2, 1-2. It's basically saying that gold needs to break out big time topside, or else this wave count is incorrect. So this is my alternate count, and that's why I have 1206, 1197 as do or die. I think a more proper wave count is going to be over here on the next one, which I'm going to show you. And this is what people don't understand a lot of times. Sometimes a failed wave count is just as powerful as a strong or a correct wave count. I am covering my bases here, and this is what people don't understand is Elliott is a trading methodology. It's not a forecasting tool, it's a trading methodology. It's something that, you know, if I try to go on TV and I just say this is what's going to happen based on the Elliott wave count, this is the only way the market's going to go, I'm going to look like an idiot, because Elliott is not a one-dimensional forecasting methodology. It's a trader's methodology that helps you measure probabilities, risk, reward, and helps you look at multiple scenarios. The analogy I like to use is you're a general going into battle. You're never going to have one wave count and one plan and say this is the way the battle's gonna unfold. No, you have multiple scenarios and say if A happens, then I'm going to do B. If C happens, then I'm going to do D. And basically, I am in battle right now. We are in a gold position that is expecting this wave count to fail. And I want this wave count to fail because I think it's low probability. Is it a fault of Elliott that this wave count is probably going to fail? No. Okay. Is it a fault of Elliott that it is subjective? No. It's a good thing because it's a trader's methodology. Okay. So the alternate count that we're looking at is instead of 1-2, 1-2, 1-2, this whole thing is an ABC connected to an ABC. And this whole thing is just corrective from those November 6 lows, and we are going significantly lower. If you look back at longer term I think it's very easy to count a bunch of 5 waves. Okay, inside of wave 3, this is where you want your 5-wave move to be. 1, 2, 3, 4, 5. And in fact, I'm going to make a quick change because I want to make sure wave 3 is 5 smaller waves. Decompose impulse, and there it is. 1, 2, 3, 4, 5. And I even can make wave 3 5 smaller waves. So basically, we're seeing 5s all over the downside of this chart. Okay, that's what you want to see to know that we are in a 4th wave. And that's a nice little triangle, up and 4. And then do we have another 5-wave move? Oh, absolutely. 1, 2, 3, 4, 5. Then look, guys, compare this price action to this price action. You see all the overlaps and the chop and everything? That tells you that the 3s are pointing up and the 5s are pointing down. Okay, so that makes me feel like, okay, I think this thing is going to head lower. So we put a trade on yesterday with clients. We put on a wave 3 debit spread, which basically is this. All right, so in the GLD, we went long the Jan 113 puts and sold the Jan 108 puts. So it's a wave 3 spread. All right, what that means basically is if this is wave 1 up and 2, wave 3 should go at least as long as wave 1, and that's your 100% 3v1 relationship. So if this is 1240 to 1190, that's $50. Wave 3 should be at least $50, which from the highs here at 1224, take away $50, and that's about 1170 area there. Okay, so we want this trade to kick in once we get below the 100%, and we're short down at the 108s because we think the market's going to move down in this area. So we're trying to capture this spread. It was a cheap spread because these long puts are out of the money because obviously we're up here. So we didn't pay very much for the trade, but based on the analysis that we did, showing 5s down, 3s up, kind of think that gold should be dropping. Okay, and we paid, I think, only $1.13 for the spread, and we can make up to $4 on it. So it's got like a 4-to-1 risk, reward to risk ratio. And depending on the Fed, what they do today, we'll see. But I think the path of least resistance is lower. The other thing with gold, on a intermarket point of view, is gold is a volatility hedge as well as a falling stock market hedge. And volatility has been spiking sharply. I mean, you look at the VIX, we're at 23.5. That's a pretty impressive move. Okay, if we go over the daily, the VIX has been rising quite sharply since that December 5th low, which was the high in the stock market. Gold has had every opportunity to rally, okay, with a higher VIX and lower stocks, and it just hasn't. So therefore, based on the wave count and the intermarket analysis, we put on that trade, and so we're going into the Fed short gold. I am long small stocks, no crude positions. We have XLE. We are short the 82.83 put spread, which was up here. We sold 82.83s when it was back up here. We also did a long put vertical, and we took max profits. We did an 80.75 put spread and took max profits, and we're just kind of hanging around there in crude. So crude can go lower. I think gold can go lower. The dollar is rallying. If you guys heard about what's going on here with dollar against Russia, I mean, this is just like unbelievable. This is unbelievable what's happening here. Let me bring up my FX workspace. And it's giving me a hard time. There we go. Come on. I have to go out to the weekly charts to show you what's going on. So Russia is getting destroyed from this currency move. So much the fact that a lot of FX brokers aren't allowing you to trade anymore because they don't want to get involved. This market has gone from, in 2014 we were at about 32. We went like 2.5 times higher, 250% higher in that. Currencies usually don't move more than like 10% a year. This went 250%. Just massive, huge move. So here's the preferred wave count we're looking at in dollar Russia. It matches up with crude, and what's going on is basically the dollar is rallying against Russia. Dollar's rallying, Russia's selling off. I think we are in a fourth wave correction that matches up with wave 4 from November 7th to November 24th. Okay, so here again, 3 waves, 5 waves. Okay, and even inside of wave 1, you can count 5 waves. Okay, 1, 2, 3, 4, 5. Even inside of wave 3, you can count 5 smaller waves. And here, that's clearly a 3-wave move. So now in wave 4, we're looking for a 3-wave move. So what should happen as dollar Russia pulls back, then crude oil should be able to rally. Remember, our outlook for crude was for a wave 3 low and a wave 4 rally. This matches up with dollar Russia, which has a wave 4 sell-off. Okay, dollar Russia and crude are going to go inverse to each other. If you were looking at the currency quote as Russia US dollar, ruble US dollar, they'd be trading in the same direction. Okay, so using intermarket analysis, you can fortify the wave count and say basically we should pull back to about 60 to 57.5 in this area, chop around for a while, and then we should make another push higher as crude reaches down for that $50 level. Okay. Brett, I'll jump on Norway, I promise. Dollar Norway is the other one. Just not quite to the extent of Russia, but Norway gets about 30% of their government revenue receipts from energy. So the currency has been actually it's dropped more than, well, not 30%. 6. So even in November, I mean, this thing started down in September at around 6, and we're up at almost 8. So, all right. So 2 out of 6, right? So it lost a third of its value, which makes sense because that's a third of its revenue. But I don't know, overdone. I'm not going to get into fundamentals. But again, this is a wave for a pullback. Same degree. This is a degree that is the minute, and it's going to match up with this wave 2. Pullback should be into this area. So we're looking at some fib support in here. Down around 740, 730 area here, and this should correspond again with that wave 4 rally up in crude, and then moving higher. Okay, and what's interesting is the dollar is not rallying straight across the board. We are looking at non-oil producing countries who actually benefit from weaker crude, and countries like Europe, the euro is what I believe to be in a 5-wave low, 1, 2, 3, 4, 5, and we should have a rally back up to about 130. Okay, am I merit to this count? No, I have pretty low confidence in this count, but I do think the path should be higher for now. Okay, I'm not trading it, I'm not putting any money behind it, I'm just kind of casually watching it. Dollar yen. Dollar yen, nice count. I still think the path to resistance is higher. This is a nice conversation of dollar against the yen in terms of wave 4 versus 2. Okay, this is a very clean wave count. Let me just hide everything below that degree. 1, 2, 3, 4. Okay, the way you measure fourth waves is you click on the degree, you right click, you ratio analysis, 4v2, 4v3. Those are your 2 wave 4 studies. And you're looking for the green and orange levels. Okay, 2 green levels at 117 and 115. So we're beginning to hold the wave 4 low. And would you just go and put the wave 4 right there? I think the answer is no. And the reason is this. Usually wave 4s last longer than second waves. So if you go like this, ratio analysis, and then go to time analysis, 4v2, you would expect the fourth wave to be at least as long as wave 2 in terms of time. So if wave 2 ended on October 1st and went down to October 15th, that's pretty easy. That's 15 trading days. So you'd expect wave 4 to be at least 15 trading days. And that is the 100% 4v2. And that's on December 22nd. More often, we'll go out to the 1618 or the 200% of 4v2. That's the last trading day of the year, or January 6th. Okay, we could even get out to the 2618, which is out there. So that goes out to January 15th. So the answer to the original question was, is this all of wave 4? No. But what's interesting is we've gone down and tested the 2 green support levels. So you could say the low for price is in, but I don't think enough time has been chewed up on the clock for wave 4. So what you do is you say, all right, I'm going to bring in one small degree and say, all right, This is probably what's happening. This is probably just the first wave of wave 4. Okay, it's probably just A. Then we're going to do a B wave, and then we're going to do a C wave. So that's going to look like this. Let's go from the daily, let's go down to a smaller time frame, get a better view to the 3-hour. And if wave 4 is going to last out towards the end of the year into the new year, we'll put it right here. So there's January, we'll put it on the 1618 right there. Okay, so there's the ABC down. So the way that's going to shake out is, delete, get all these extra labels out of the way, decompose as a correction. It's probably just the A wave, and then we're going to have a B wave rally. So far, guys, I see this as a 5-wave or 3-wave move. A, B, C. These are beautiful 5-wave moves. This is a choppy A, B, C. I think this is a correction. So it's going to go decompose as a correction. I think this winds up being a triangle. And it's an ABC move down. So that would mean we're at price support, but we're not quite at the ideal time duration of wave 4 versus 2. And I'm talking the green degree. So what you'd expect is, fine, we can get a B wave rally, but it's not going to break out. It should fail around the highs. So I think what's going to happen here, guys, is dollar is going to rally against the yen post-Fed. I think stocks are going to rally against everything post-Fed. Okay, we went over the S&P into lows. We went into crude oil, finding a low just for now in wave 3. I think the dollar rallies against the yen, which as the correlation between dollar, yen, and stocks are positives, I think the dollar rallies against the yen based on this move. And if the dollar rallies, there's a pretty clear-cut correlation with gold. I think that makes gold sell off. So that's why we're short gold. I think dollar yen rallies. I think stocks rally. I think gold sells off. And that's the plan we're using going into the Fed. Okay, guys. Do you have any questions, any comments here before we sign off ahead of the open? If not, I'm going to leave it there, guys. And Carlos, no, Euro, as I said, I don't have a strong opinion. I think it's one of the most underplayed currencies right now. Just not a lot of correlation to what's going on. The dollar yen's in play. Those commodity oil-based currencies are in play. And Tony, sorry I didn't do the Canadian dollar. I can look at him quick if you like. The Euro's just not in play right now. It's just quiet as I went over. Let's do dollar CAD quick. So dollar CAD, I think, is pulling back also in a 4th wave. And post triangle thrust from December 3rd, it's going to be black 1, black 2, black 3. Nice 5-wave move. 1, 2, 3, kind of choppy here. 4 up and 5. That's cool. ABC down in 4. Force find support between 116 and 115 and we rally up. So I definitely like to buy dollar CAD on a pullback, as I'd like to buy dollar Norway. And I wouldn't tell you to buy dollar ruble because that thing is just insane right now. You don't want to be trading that. So dollar CAD looks good, and those oil plays look good. Dollar yen, I like buying. It's just it's a B wave break, so don't get too caught up. And the other thing that looks pretty good overnight is the Australian dollar got very weak overnight, and that's a commodity play. Aussie's been in a pretty clean downtrend here. I'm not very confident of the wave count, but wave count aside, I mean this thing's just in a downtrend, so that makes me confident to be short gold. Okay, the other thing, non-stock or non kind of macro hedge fund kind of stuff is you guys noticed Google yesterday? Google just got crushed. Google and Microsoft. Google did break through $500. Looks like it's back above, but Google was really hit hard yesterday, as was Microsoft. They were both down about 3%. So we'll have to watch those guys here today in the open. Let me bring over this. So here's Google. This is on the 30-minute chart of Google, just real sharp decline down into the 500 level. So that's a pretty good decline there. Not tracking any wave counts at the time that I'm confident in. Those two look invalid at this point. But Google weak, Microsoft weak. We are looking to buy Intel. We did get long RTH retail ETF on lower oil prices. We are short the emerging markets ETF, which is a lower crude oil play. And we still have some XLE. So those are our position holdings right now at the biz. Okay, guys, we'll leave it there. If you don't have any other questions, I wish you guys best of luck in the Fed today. And we will be off next week, obviously, Christmas Eve, no Wednesday webcast. Hope you guys are all enjoying time with the fam and family, friends, and we'll look forward to catching up with you. Ooh, no, 2 weeks we're going to be off. I don't know. We might do the 31st on New Year's Eve. We'll take a look, see how the markets are. So we might do the 31st. I'll talk to Tony and those guys at MotiveWave and see what we want to do. But it's possible we'll be off for 2 weeks. So bummer, but again, be sure to check out MotiveWave.com, TradingAnalysis.com, and for all your charting research, trade signal needs. Guys, have a great end of the year and good luck in the Fed. So talk to you soon.